Hello, everyone. Welcome to another great webinar from cpaacademy.org. My name is Jasmine, and I'm so happy that you all have decided to spend the next hour with us. I've got Michael Kelley coming to you from Parkview OZ REIT. So happy to have him back on the platform. You should see his webcam active right now, and I'll be turning things over to him in just a moment. But before we get started, I want to make sure that everything's working for our audience. So if you haven't already, go on over to that Q&A panel on the right side of your screen. Type me a message there to let me know you can hear my voice. You can see that title slide. And while you're over there, if you don't mind, type in a message to let me know what you're hoping to learn today. What made you sign up for this course? What are you hoping to gain by attending today's webinar? We'd love to know your expectations, and we'll do our very best to get those satisfied in this hour's worth of time. Of course, there is a big group here today. I definitely encourage you all to submit your questions and your comments throughout the webinar. We want to keep it engaging. And we do have Grace here as well from the Parkview team to help address your questions in real time. So go ahead and submit questions, comments over there in that Q&A panel. Now, the Q&A is private to just us on the panel, but we do see your responses. I'm seeing Maryland, I'm seeing California. Alex says, I can hear you. Jeffrey is here. Awesome. Woodstock, CPE, and curious about Opportunity Zone tax incentives. Thank you, Dawn. Judith in the Twin Cities, working on getting P10 credits. Rosemary, helping clients. Let's see, Colorado, Wichita, New Jersey, New York, Vermont. All good. Well, thank you so much. We got a big group, as I mentioned. And we'll do our best, like I said, to get your questions answered live on air. And if you leave the webinar with any unanswered questions, you will have a way to get in contact with the team directly to follow up. And we'll also submit all questions asked to the Parkview team in a full report. So we'll make sure to get that in front of them. Now, I did want to mention credit. You all have mentioned, some of you are here for CPE or CE credit. We're offering CE credit to those of you with a P10 on file, and we'll upload that CE credit directly to the IRS on your behalf. Those of you looking for CPE will get your certificate issued within 24 hours, and that'll be in your cpaacademy.org account, along with the archive recording of today's webinar, your handouts, and your course evaluation survey. So you will get a chance to give us some feedback about your experience today once the webinar is over. I did mention we're recording the webinar, so you'll have access to that a little bit later. And the handouts, 2 of them, you have them available right now for download in the handouts tab. One is a copy of the slide deck. The other is a copy of the blog post written by our instructor. So go ahead and grab a copy of yours now. With regards to credit, we are issuing that via poll questions. So stay with us for 50 minutes total. Respond to at least 3 of our poll questions. You'll earn full credit. And like I said, I'll get that uploaded to your accounts within 24 hours. Checking back on our audience. Will it be in the P10 account? It will be uploaded, Michael, if you have a P10 on file with us. If not, go ahead and visit your My Account page at cpaacademy.org and make sure that's up to date. And looks like everything else is working. So I'm going to go ahead and turn things over now. Michael, our attendees are ready and the floor is all yours.
Thanks, Jasmine. Thanks for that very nice introduction. That was a great question. What brought you here today? We'd love to hear whatever the reason is that you're looking into opportunity zones, whether it's a specific situation or just trying to learn more or get CE. But anytime there's a change in the tax code, there's opportunity. So I'm very excited about today's presentation. I will try to leave about 10 minutes at the end for a Q&A. So definitely encourage you to put in any questions. And we also love comments and feedback. One of them was to leave more time for Q&A. So we're trying to make the presentation as strong as possible for you. And this is the disclosure slide. I won't read it all to you, but today's discussion is just for informational purposes. It should not be considered tax, legal, or investment advice. So this is some of the top 10 changes that people are talking about with the new bill from this summer. And I was not surprised to see that opportunity zones did not make the list. They're, I would argue, a hidden gem. They're something that most people still don't understand, but are really powerful, really worth your time. And that's an advantage in a way, because if your competitors don't really understand it yet, it's something that, if you have command of it, it's a great potential differentiator for you and your business. So we're, QOFs, they're broadly applicable. Anyone with a capital gain of any size is eligible for 180 days to get these tax incentives. They're powerful. It's very Roth IRA-like on the long-term benefit, which is the 30 years of potential tax-free compound growth. So that is really an amazing benefit. And then, as we'll talk about, the deferral strategy, the short-term benefit, is really like a Swiss Army knife. It can be used in so many different ways. I'll touch on a few of them, but we don't have time to go through all of them. When you start thinking about when you can shift income to different tax years, a whole lot of possibilities open up. So this is as I touched on, this is a real differentiator. It is a great way to show that you're current on the tax code. And I get a lot of calls saying, I read an article on opportunity zones. I went to my tax professional. They weren't able to answer my questions. So they'll look around and wind up talking to us. But it's something that investors are looking at, and a lot of tax professionals aren't quite up to speed on it yet. So it's a great way to show that you're current and you're putting the work in as you are right now. And it's also a very tangible benefit. So you can show through different planning options, different outcomes that have real financial impact. Moving businesses towards tax planning from just the more filing centric businesses is always good. Higher margins. The really important thing is it deepens your client relationships, so you can have a 12-month relationship with them rather than just around tax season. This is the agenda for today. I'll go through the first part's the most important, the foundational knowledge. It is not that complicated. I think, it's really pretty basic, but a lot of people never take the time to get that foundational knowledge down, and they get sort of twisted up in what they think the opportunity zone tax incentives are. So we're going to go through that. If you can get a grasp of sort of the foundational way that the program works, that's going to help you a lot as I talk about the strategy sessions and using it with your own clients. We're going to talk about enabling tax planning. Our fund, Parkview OZ, is all about enabling you to use opportunity zone tax incentives for tax planning. And it's not the way the industry sort of developed it. There were access issues and a lot of things that restricted the ability of these incentives to be used. So we think of Parkview OZ as a problem-solving mechanism where we're out there. That's the way we think about it. If we're the client, how can we make this better for people? And then we'll go into how to use the long-term benefit. The one I mentioned is sort of like a Roth IRA. And then we'll finish up with the short-term strategies, the deferral benefits, and a few examples of how that might be used. So going into part one, the basics of OZs. So this is the new incentives. This is what was just passed this summer on the 4th of July with what I call OB3. You now have the ability to defer capital gains for up to 5 years. That lasts for 5 years or until you sell the QOF, whichever comes first. If you stay in the whole 5 years, you get to eliminate 10% of your original tax liability. So you can think of that as like a 5-year interest-free loan on your original tax liability with 10% principal forgiveness. So that's a pretty good benefit. the biggest benefit by far is the ability to grow the QOF investment without any tax liability for up to 30 years. It is really amazing. And as I mentioned there, we love Ross. It's just hard to get money into them sometimes. And you don't see those same issues with opportunity zones. So what is a qualified opportunity fund? I think the big thing to remember here is that it's the way the IRS tracks compliance. So QOFs were not around before this legislation, so they're specifically created to be the entity through which the IRS tracks compliance. And we have a lot of things as a fund that we do to comply. We'll save that for a different webinar, but the important thing to know is if you make the exact same investment with the exact same fact pattern, but you don't use a qualified opportunity fund, you will not be eligible for the tax incentive. So it's a necessary mechanism. So what is an opportunity zone? They're based off of census tracts, which are like zip codes, but a little bit smaller, typically 2,000, 8,000 in population. So they're whole towns and rural areas and just neighborhoods and more urban neighborhoods. The first round of OZs, there were 8,700 of them, more than that, and they're in every state. They're now going to rotate every 10 years, so you'll see them change. Not all low-income neighborhoods get designated, so these will be rotating areas as the program goes along. And with a 30-year benefit and the census tract only lasting 10 years, it's important to know that the census tract only has to be active when you're making the investment. Then you enjoy the benefits for the full length of the 30 years. So what capital is eligible? Basically, if you sell something for an appreciated asset and you owe a capital gain liability on it, that is an eligible benefit. You don't. That is an eligible capital. So it's unlike a 1031. It's just the capital gain portion that is eligible and needs to be invested to defer the whole capital gain liability. The principal is not involved, but it's really you've got 180 days to get it once the gain is realized into a QOF, and then you've got an eligible capital. Who is eligible? Basically, if you owe money to the IRS from a capital gain liability, it doesn't matter if you're a U.S. citizen or not. It doesn't matter if you're living overseas or not. You can be an actual person, a corporation, or a partnership. It's just a very, as long as you are owe a capital gain liability to the U.S. government, you qualify. And one of the things about qualified opportunity funds, you can invest in them even with non-eligible capital. That's not a problem. You just don't get the tax incentive. This is a really important slide. I kind of repeat it a little bit coming up here, but this is where people get twisted up. A lot of people think that all of the benefits go to the original capital gain, but it is actually, there's hopefully two capital gains. There's the capital gain, which you just realized, be it from stock or real estate or crypto, whatever it is. And then hopefully the second capital gain is from your QOF appreciating in value. And the first benefit, the original capital gain, gets the deferral benefit. What I'm referring to is the shorter term benefit. And the qualified opportunity fund appreciation gets the elimination benefit. That's the benefit that lasts for 30 years from the date of your purchase, but you have to hold at least 10 years to get that benefit. So this is the original program. This is the one that's actually still active right now. You can see that the original capital gain has a deferral until the end of 2026, which right now is only 1 year. And the elimination benefit, you still have to hold it for 10 years, but the elimination benefit expires 22 years from now in 2047. So this is the temporary version of the Opportunity Zone program that we've had for the last few years. And these benefits have been getting a day shorter every day because it was a temporary program. So they had hard dates of when these things ended. So we're getting near the end of that program. So what did OB3 change? It made opportunity zones a permanent part of the U.S. tax code, at least as permanent as you can be. You now have rolling benefit periods instead of being a hard date for everyone to invest. It's 5 years from the date you purchased your QOF is when the deferral period will end. And if you hold that QOF for a full 5 years, that's when you get the 10% elimination on your original capital gain. And then the long-term benefit is similarly, it is now 30 years from the date you purchase. The date you purchase the QOF is when that expires, and it's still 10 years that you need to hold to get that benefit, the elimination benefit. So this is the same chart with the new incentives put into it. So the original capital gain, 5 years, 10%, and the QOF appreciation gets the potential for 30 years of tax-free growth as long as you hold it for at least 10 years. And with that, I think we will launch the first question, Jasmine.
Yeah, that sounds great. I'm going to go ahead and launch that now. And that question should be live for you all. If you're not seeing it for some reason, please refresh your browser. You may also need to check the polls tab. We'd like to know how you'd rate your knowledge of the Opportunity Zone program. If this is your first time with us, please click the radio button that corresponds with your answer and be sure to click submit so that it counts for credit. And interestingly, I'm seeing those results coming in. Looks like about half of our audience is answering none. About 36% are saying fair, 10% good, and about 4% excellent. I'll let that keep running in the background, but for now, I'll turn it back over to you, Michael.
Great. Thanks, Jasmine. So one of the driving, desires of us as a fund was to make these tax incentives work better for people because we thought that they weren't quite optimized the way most funds were done. So I just want to talk a little bit about the program and sort of how things got set up. I mean, it is a great program. It's broadly applicable, as I already said, versatile. We'll talk about that, and very powerful in its tax benefits. More than $100 billion have been invested in qualified opportunity funds. The Treasury Secretary originally estimated that it would be $100 billion. It's already past that, and we've got some time left on the original temporary program. The problem is, and the one we're trying to solve, is that really only a narrow base of investors participated. It's largely been private equity and family offices that have gotten into it. So the majority of funds are set up as single project funds. And basically these were private equity development vehicles. And when they were investing in a qualified opportunity fund, what they would do is they would layer on the Opportunity Zone benefits so that investors who were investing in these would not only get their appreciation, but it would be tax-free. It was a very smart thing to do. A great use of it when you're investing in a particular project, but it's difficult for tax planning purposes. And basically, these funds would typically last for 4 to 7 years. They delayed how long you have to hold a minimum of 10 years. So they would basically hold on to the property for a significantly longer number of years to reach that 10 years and have it be tax-free for their investors, which is great. But the manager is typically paid through carried interest or a promote fee, which is a profit interest, and they don't get that until the property is sold and they know what the profit is. So that meant that most funds ended after 10 years. And knowing that it's a 30-year benefit, it's kind of a crazy thing. And that just points out that these funds are really structured to make an investment in a particular property very tax efficient. They're really not optimized for tax planning. That's not what they're trying to do. So for tax planning, there are a few problems. You've got K1 partnership tax forms. When you think about most people who invest in the stock market and are active, they don't want to deal with K1s and the issues that go along with them. These private partnerships that dominate qualified opportunity funds are typically require accreditation requirements, which prohibits most investors from investing. And even if you are accredited, you may not want to go to the hassle and invasive process of proving you are. Partnership minimums. Any capital gain is eligible for this program, but for these partnerships, you need to put in usually 200 grand or more. That's a lot of money to tie up for a long time. A lot of people aren't willing to do that. And they may not have, if you've got a capital gain of 75,000, that may be well worth deferring and taking advantage of this program, but it wouldn't be enough to get into one of these funds. And then for tax planning, as I'll talk about quite a bit in this presentation, you really need to have control of your holding period. That is absolutely essential. So these funds, they need your capital to do the project. So they lock you in for 10 years and then they sell after 10 years and liquidate the fund. Again, works very well for them, but not great, for what they're trying to do. But it's not great if your intent was to use this for tax planning purposes. For these reasons, I was watching a presentation a friend of mine was giving. It was a tax attorney. He started calling QOFs AIVs for awkward investment vehicles. And, again, that's the problem we're trying to solve. We're trying to make it easier for people to invest in these things and enjoy these tax benefits because they're really powerful, but they are awkward the way that they were set up. So we're hoping to offer a solution to that. So Parkview, we're trying to look at things from the investor's perspective. What do we want as investors? And we are in the fund. What is it that is really helpful to us? And we've really done our best to do that. I believe we have the lowest fees in the business. It doesn't really make sense to save on tax and then give it back in fees. We have publicly traded shares. PVOZ is our stock symbol. And we have a corporate structure. We're set up as a REIT, and that offers a lot of benefits. So people are able to buy and sell when they need to. We have a electronic subscription agreement on the site, which is great for liquidity. You can also buy and sell it in your Fidelity or Schwab account. You wind up with simple tax forms, the tax forms you get for any stock purchase. No minimum investments. You could buy, one share in your brokerage account if you wanted to. And, we went through a vetting process and we don't, because we did that, we have public shares and don't have accreditation requirements, which is great. So it's much easier to implement financial plans. Being able to choose the holding period that fits you or your client's financial needs is really essential. And it's really important all the way through the fund. There's a lot of choices you can make. You always want to line up the interests of the manager with the investor. And for that reason, we don't have any carried interest or promote fees because that would make us want to sell properties. And in a qualified opportunity fund, it's kind of quirky. The tax incentive goes to the investor only. If the fund creates a taxable event, like selling a property, like you might want to do if you want to get paid with carried interest and moving to another one, if you realize that gain in the fund, it will trigger a tax, which in a partnership would flow through directly to the investor. So you don't want to do that. So we eliminated the carried interest, profit interest, and we think that better aligns our incentives with our investors. This is what we look for is properties where we're in areas that are seeing very long-term trends in population growth and employment growth. And this is Tampa Heights. Tampa has seen a resurgence. Downtown Tampa has seen tremendous investment. That's the adjacent neighborhood. And you're seeing all sorts of improvements in this neighborhood in Tampa Heights, where this property is located. If you look out the window, you can see Armature Works, which is there on the left, which is a converted factory, which is now a 20 bars and restaurants. Very nice place to hang out for the afternoon. There are craft breweries popping up. The Riverwalk starts right in front of Armature Works, goes all the way downtown. It's a spectacular place to take a walk. If that's your commute and you live in Tampa Heights, that's a pretty nice commute if you're going downtown to work. It is really a great place to go. And this neighborhood needed capital. It definitely had sort of a lot of crumbling buildings. And now, because like I said, not all neighborhoods are chosen as opportunity zones, this is a very attractive neighborhood. You're seeing all sorts of capital flow into the neighborhood. And that's the idea, to get critical mass to break the cycle of poverty. And the building next to us has been heavily renovated. The building across the street is brand new. So there are all sorts of things going on. And you sort of get that slingshot effect of valuation as crime rates drop and the neighborhood gets invested in, which I think over the long run is a great advantage for investors. So what we operate the fund. We are not real estate developers. We love partnering with real estate developers, and that's great because we can look at different areas. If we're looking at Tampa Heights or Austin, Texas, we can partner with a developer who has expertise in that area and knows how to get projects done. We also tend to get involved with projects after they're already underway, which is a great way to reduce risk. And on the investment professional side, we're very eager to create relationships and educate, because ultimately that's good for our business. And very happy to, if you have a company or a group you want us to speak with, very happy to do that. And I hope we continue the conversation after this webinar if it's a topic that you find interesting. And Jasmine, I think we're coming up on question number 2 before we dive into the long-term benefits.
Yeah, sounds good to me. We've got poll number 2 launched. Let us know if you feel that a qualified opportunity fund investment could be helpful for either yourself or a client. We've got 5 options to choose from. Go ahead and submit your answer as soon as you can. I definitely appreciate those of you who have been submitting questions via the Q&A panel as well. Please keep them coming. And we're going to go ahead and let this poll keep running in the background. Again, this is poll number 2 of 4. Looks like the most popular answer is maybe, followed by yes for a client. I'll go ahead and give it back to you, Michael.
Great. Thanks, Jasmine. So diving into the tax-free benefit. So this is, I saw there was a question there talking if there's ever 100% step up. And there is. It's the long-term benefit is what delivers that. So that gets the money into that, the potential for tax-free growth. So that's a great bucket to be in. It's difficult to get into. There's a lot of restrictions on getting money into them. And qualified opportunity funds are a new way. Most people are going to wind up with money in all 3 of them, but the more you can get into tax-free, in my opinion, the better, because it adds better clarity. I mean, you don't know what tax rates are going to be or what new taxes they're going to be looking out 10, 20, or 30 years. So it is one variable that you could potentially take out if you can get money into that tax-free bucket. So I think it's a great way to help figure out a little bit better what your available spending is going to be when you eventually need the money. So Roth IRAs, we're big fans of. They're versatile. Everything in the account gets the benefit. With QLFs, it's really the investment itself. The QLF may own additional assets, so multiple properties, things of that nature, but it really is one investment, whereas a Roth IRA, you've got a lot of variety. The problem with Roth IRAs is that Congress realizes how expensive it is to allow people to grow assets tax-free. So they put caps on it, and for whatever reason, they did not. I'm kind of surprised that they did not with QOFs. You can get any sort of dollar amount, whether it's a $10,000 capital gain or a $10 million capital gain. You can invest within 180 days into a QOF and get the potential for tax-free growth, which is a great way to go. I think it's a great way to complement a Roth IRA strategy and get more money into that. And if you're trying to play catch up, it's on your retirement savings. It's also a great way to go. So I just want to talk about how the elimination benefit works a little bit, because the mechanism is important. It's better than just eliminating the capital gain. You're actually eliminating the capital gain income. So you're not eliminating just capital gain tax. So the way it works is, once you've held the qualified opportunity fund for 10 years, you get to elect to step up your cost basis to whatever the current market value is. So whatever you're selling it at, you can bring that cost basis right up to whatever the current market is. So that eliminates the capital gain income completely, which is great, because if you've got net investment income tax or some tax in the future which targets capital gain income, something we haven't even thought of yet, you're still in a good position, because there's no capital gain income to tax. Anything times zero is zero. So it is not that easy to run a QOF. You really have to do certain things to make it work well. So as I was saying before, only the appreciation of the QOF gets that step up. So what I described, that step up in your cost basis on the QOF, that is the benefit. That's the whole benefit. People think, well, the QOF must be a whole tax-free entity, but it's not. It's just your ability to step up your cost basis to whatever the current market value is. And if the fund were to sell a property, an appreciated property, if say you're in a partnership, that would flow through to you. That would also step up your cost basis because you paid it. And it would completely nullify the QOF's tax incentive. So it's really important to buy and hold. That's why carried interest doesn't work, because you would wind up never getting paid. So you don't want to incentivize someone heavily to sell a property when it's not a good idea tax-wise for you. Again, if it's a single property QOF, that is not a problem, because but if you're trying to continue on and run a perpetual fund, which is going to be open for decades, that's you don't want to have carried interest in there, or any incentive that would incentivize the manager to do something that wasn't in the best interest of their investors. So the elimination benefit, this is something you've all seen, but I always get surprised when I look back on it, how powerful it is. But the tax-free compound growth, obviously a great way to build wealth. And the key to it, you talk about the analogy of a snowball rolling downhill and trying to grow it, and it's those last few revolutions that pick up most of the snow. Same with investments, except we're talking years. The last few years are incredibly powerful. So a lot of people think of the long-term 100% step up as a 10-year benefit, but that's actually only 10% of the potential. If you held for the whole 30 years, if you considered that 100% of the potential tax savings, I'm just using round numbers here for illustration purposes, the how skewed it is really amazing. So at 10 years, you capture just about 10% of it. At 20 years, it's still only a little more than a third of it. So it really pays off to hold these things as long as you can if you're trying to create wealth. And tax-free compound growth is an amazing way to go. So just in summary, I mean, my 2 cents on it, Roths are a great vehicle. They're a little more flexible. They're just harder to get into and get capital into. I would consider a QOF for any sort of realized capital gains. Just sort of look at the situation and see if it makes sense. And then staying in for as long as you can really pays. So for this to work, the investor needs to be in control of their holding period. They need to be able to exit whenever they want. As I said, it's 30 years from whenever they buy their QOF. So everybody's situation is different. I will just mention, it's not in the slide deck, but if you pass away, your beneficiary steps into the shoes of the benefactor, and it winds up, they have that exact same holding period as though it had been them. So it's actually a great way to pass on assets. It's better than a step up on death, because this is a step up whenever you sell it up to 30 years. The fund should be run as a perpetual goal life, because every time new investors come in, they've got a 30-year run. And a buy and hold strategy is essentially, you can't have taxable events within the fund, or they will wind up reducing the value of the fund or flowing through to the investor and nullifying the tax incentives. And low fees, again, are critically important. And Jasmine, I think we got question number 3 ready. Jasmine, you there? We may have lost Jasmine.
I am trying again with my audio. Can you hear me now?
I can hear you.
Okay. I did go ahead and launch that poll. I'm not sure why my audio wasn't going through, but our audience did not miss a beat. They have already been answering rapidly. It looks like about 41% say they like to do further research, and a little bit evenly split among the other remaining choices. And with that, I'll let it keep running in the background as usual, but I'll give it back to you, Michael.
Okay, great. Thanks, Jasmine. So we're going to get into the deferral benefit. This is the benefit on the original gain. Talk about how that works and how it can help you with tax planning. So the original gain that you have, you invested in the QOF, that gain does not change. Whether it was long-term or short-term, or from something like collectibles that are taxed a little bit differently, the character does not change. The only thing that changes is the realization date, and there's a lot you can do with that. One of the things that has come up is that the legislation inadvertently created a dead zone. So many investors, the fear is that they are going to pause their OZ investments because the enhanced benefits of the new bill don't kick in until January 1st of 2027. You can make an investment in a fund in December of 26, you're going to get the old incentives. If you invest in the same fund, same person, just in January of 27, you're going to be eligible for the new tax incentives, the enhanced tax incentives. So we'll talk a little bit about that. It's a concern because it really stops. I talked about how it was a hidden gem of the OB3 bill, and part of that is because these incentives don't kick in till later. So some of the other incentives started right away. So there's a lot of press and media about that. But the real concern is that it's going to stop flow to the capital, to the neighborhoods that the capital is really intended to help. So it's sort of the opposite of the legislation. There is a workaround to that, which I will discuss. This is the differences in the program. So the timing of the eligible investment, any investment in a QOF prior to 2027 is going to be in the current program. Anything after January 1st of 2027 is eligible for the new enhanced benefits. So the eligibility of the capital is still the same. It's 180 days from your realization of the capital gain. So if you were to realize a capital gain today, 180 days is not going to get you into 2027. So that is an issue. there is a solution which I will get to, but you can see the differences. And pretty soon, as we go into the new year, that deferral benefit will be completely gone. It's already down to 1 year. And then the long-term benefit, the 100% elimination benefit, that is only 22 years. But as I showed on that compound growth curve, those last few years are big. So if you can get to the enhanced benefits, it is probably a good idea. One of the things, a lot of people don't realize this, is that you can sell a QOF. And as I was saying, the character stays the same. It's your original capital gain. It just has a new date. And any capital gain can be invested in a QOF, including gains that had already been deferred by a QOF. So you can reinvest. It does reset the clock. So each time you go from one QOF into another, and Congress does not care what QOF you're in. They just care that the money's going into these neighborhoods that need the capital. It's going to reset your 5-year deferral clock, and to get to that 10-year, to get to the 10% tax elimination. But you can daisy chain these things together and keep the deferral going. Also, the 10-year clock, if you want that 100% step up in the elimination, the 10-year clock resets each time you change. The 30-year benefit also resets. So if you go from one fund to the other deferring, you're never going to get the elimination benefit, but you can keep that benefit going. And it's really good to know, especially in this situation, that you can defer a gain, sell it, and then have another 180 days when the gain is still eligible for further QOF deferral. So that leads us to our bridge strategies with the issue with the new bill starting in 2027. If you invest, if you have a current capital gain, you can invest in a QOF now and defer across that eligibility gap. You can sell in late 26 or early 27, and you're going to have that 180 days to reinvest into a new or potentially the same QOF. And now you're eligible for the new benefits, which helps quite a bit. So the results of it keeps capital flowing into OZ communities. I think it's very much in the spirit of the law. I think it was very inadvertent. Congress was dealing with the overall tax bill. They didn't have time to merge the two together. So they did sort of the simplest thing. But it keeps capital eligible for OZ 2.0, and it keeps money going into these communities as the bill intended. Another use, second use of the deferral benefits ability to shift when you are realizing a capital gain. If you've got an investor who's, say, investing in the stock market, they may have capital gains. It may be all in one chunk. In this example, say $1 million, or maybe they've been accruing gains in their QOF over time, and now it's up to $1 million in 2025. You can, if you wind up with a loss later on in a later tax year during the deferral period, you may have a really good option, much better than having just paid the tax. So if you look at this is a sort of a table showing how this might work. So that typically you've got the gain in the current year. You may want to pay it, and just sort of using round numbers here, there might be $238,000 in taxes owed. If you wound up having a loss, say a few years down the line, so we'll use OZ 2.0, say you had a capital loss 3 years or 4 years down the line, you could trigger in the first example, you'd wind up paying it, and then you'd wind up with the tax loss carry forward. If you use the QOF deferral strategy, you'd be deferring. You'd be keeping the money by investing the capital gain into a QOF. That's going to defer it until the end of 5 years, or you trigger the realization of that capital gain by selling the QOF shares. if you trigger that in the same year as the loss, you're going to wind up with zero taxes owed. They're going to offset each other. So that the net of that is that you wind up with the $238,000 in cash instead of the $238,000 tax loss carry forward. So definitely love your comments. If you have any questions, if I'm not clear on anything, we want anything we can do to make this presentation better. Love to hear your questions and comments. A second example here is if you've got, say you've got a couple and they're selling a business that they've been running for a while. They've got a $700,000 capital gain, and their plan is to retire. So they've got substantial income in that year because they're still working, still both taking salaries from the business. So they're triggering tax liabilities. Assuming with retirement, for simplicity, that they've got no other income coming in, how could you help these clients reduce their tax? I'll give you a second to think about that. If anyone wants to put their comments in, we'd love to see them. So one of the issues that comes up is that when you've got a really high tax year, like this couple has, dual income with the capital gain also being in there from selling their business, you can wind up triggering other things: the net investment income tax, the Medicaid surcharge, IRMA. You can even affect your Roth, the ability to contribute to your Roth. So there's all sorts of things that it can affect, but being able to shift the income can really help in a situation like this. So in this situation, they probably wouldn't want to take that capital gain in the same year they still had income when they knew they had lower income years coming up. You can defer the entire capital gain with a QOF purchase and then sell off portions of it over years. And a married couple filing jointly with a standard deduction can have about $125,000 in income from capital gains and still be in the 0% tax bucket. And then you'll eventually get, after 5 years, the 10% elimination of any of the original liability. And then so that I actually said in that elimination of the remainder, it should be elimination of the original liability. And that is, a great way to go. And you could even redefer if you needed to, if that was in your best interest. I used to talk quite a bit about 1031s and the differences between the two. One of the big differences in the way that they get used a lot sort of together is when a 1031 doesn't work out. If somebody is planning to do a 1031, but they take the money in their own possession, they can't identify properties within 45 days, a sale falls through, they weren't able to close within 180, all those rules don't apply to QOFs. You can still defer with a QOF. So QOFs can save the day when you've got 1031 and it doesn't work out. Also, if you've got boot, you might want to use a QOF. You might want to use it if you have a small capital gain, because remember, you can defer the whole capital gain with a QOF by just investing the capital gain portion. So if you've got a transaction where most of it's principal, the QOF is going to give you a lot more flexibility, whereas the 1031, you've got to tie up the whole proceeds of the sale. 1031 is another great way to go, but QOFs can help in certain situations. So goals of the presentation, we really wanted to provide you with something that can help you differentiate yourself from your competitors. I know from talking to people, most people aren't up to speed on this. So a lot of your competitors are not going to be ready to answer questions on QOFs. So we definitely hope that we provided you with information which might give you options that you can present to clients. And whether they do it or not, hopefully it shows that you're really digging in on changes to the tax code, and hopefully it can be a differentiator for you. And I hope we achieve those goals. You can let us know what you think. Key points, QOFs are broadly applicable. Almost every investor has a capital gain over time. Pretty much all capital gains, as long as from the sale of an appreciated asset, are good for this program. You just have to get it into a QOF within 180 days. QOFs can significantly increase after-tax returns, eliminating tax, especially in the long term, is just an amazing benefit. Stock ownership, having public shares, just makes it so much easier to access these things than private partnerships. And control of your holding period is absolutely key to tax planning. So that is a huge benefit that we feel that we offer our investors. Next steps, would love to continue the conversation. If you want to schedule a call with me, would love to discuss whatever you want to in this. And as always, love to get your feedback. There's lots of information on our website. We've got blog posts and tax information pages, and we've got an electronic subscription agreement, plus our offering documents on there, which if you want to purchase through that, that's great liquidity through there. And we also have a blog post coming up on the substantial presence test for non-resident aliens, which is coming out, I think on Thursday, or we're sending it out on Thursday. So you can think about that, think how QOFs might help, and then take a look at the blog post. Shares can also be bought in your brokerage account. We're trying to make this as easy as possible. Further reading, these are past articles I've done. I've got another one that Thomson Reuters is publishing in January, I believe, talking about the new tax incentives, talking about a lot of the stuff we talked about today. But keep an eye out for that article. These are our fund service providers. Novogradac is great in this space, in the opportunity zone space, very proactive in it. They're a 700-person CPA firm out in San Francisco. Security Transfer Corp is our stock transfer agent, and Whiteford Taylor Preston did the work on our shares. And with that, I've left some time for question. I maybe went slightly long, but maybe Grace, if you want to jump in, if there are any questions I can answer, I would love to do it.
Hey, Mike. Yes, go ahead.
No, I'll give it to you in just a sec, Grace. I
sure.
do want to let folks know that fifth poll is live, and I'll give it to you too for the remaining 7 minutes.
I forgot the last poll. Thank you, Jasmine. Appreciate it.
Absolutely.
All right, let's kick off with this question. Can gains from a 2026 QOF be reinvested in a 2027 QOF?
Yes, they can. So if you sell a QOF, if you bought it, it's I'm getting out of my depth here, but generally you want to go over a tax year. You want to hold something into a new tax year. That makes things work a little bit easier. From what I've seen with deferrals, and I'm thinking about staggered sales and things of that nature. They like to see it go across a tax year. But the bridge strategy, you can invest. You could be invested in a fund now. You could be invested in a fund in 2025. In 2026, I would definitely hold it into early 2027 and then trigger the gain. But that gain is, in the eyes of the IRS, it's just your original gain with a new date, and you're fully able to do what other people can do with their capital gains, which is make an eligible investment in a new QOF. They want you to invest in these communities. So I believe, in my opinion, they'll be happy to see that.
Right. And another one is, for clarification, how many years do you need to hold the QOF to completely eliminate capital gains tax? Is it 10 or 30 years?
It is 10. So once you hit 10, that's when you get to elect to step up your cost basis to 100% of whatever the market value is at that time. And you can do that whenever you sell. So you could do that starting at year 10 eliminating all your capital gain liability all the way back to day one. Or you could do it at year 22 or 25 or 30. It's whenever you sell, but you have to get to that 10-year hold to get that election benefit.
So another one is, what happens if the taxpayer dies 4 years after the QOF investment?
It is the original capital gain is going to come due, so that the heir would step into the shoes of the original purchaser, and the fund would still be taxable. It is IRD, income in receipt of a decedent, so it would still work just like the original buyer, but it would just be the new the heir would invest it. They would still have to hold for another 6 years to get the elimination benefit. The one thing, and this has nothing to do with the QOF, but the one thing they will not get is the step up on basis, because it is IRD that you would get for the step up on death. So that is the one negative. You've got that gap there. If they do die during that period, so during the deferral period. So it's a good question.
Is there a difference between buying shares in your brokerage account versus the subscription agreement?
No, they're the same shares. So that is whether you buy it through the brokerage or you do it through the subscription agreement on our website. They're identical. So there's no difference in terms of tax implications or anything of that nature.
Is there a minimum investment requirement?
The subscription agreement, it's $10,000. In the brokerage, you can it's trading in the secondary market. So if you wanted to buy one share, you could. So there really is no real minimum, or at least it's very low. We try to make it as accessible as possible.
Can you define recent capital gains?
So recent capital gains, it means within 180 days, but there are exceptions to when that 180 days starts. So if you had for example, it's a little more complicated than I wanted to go into in the presentation, but I would just say for like a partnership where they were worried that limited partners might not know that there was a capital gain. There's 3 different times you can start your 180-day period. So recent, to answer the question, recent means 180 days. But when that capital gain is realized in the eyes of the IRS in this program can shift. So a partnership, you have 3 different choices: when the gain actually happened, the end of the year, or when the taxes are due, typically March 15th for a partnership. And that's because the IRS was worried that a lot of limited partners might not be aware that a capital gain had occurred at the time it occurred. So that gives them a chance to be flexible and to get their eligible investment in and not have it expire before they ever found out they had a capital gain.
It looks like we are almost at the top of the hour. Do we have time for one more question?
I say go for it if you guys.
Yeah, go for it.
All right. Are there any OZ benefits at the state level?
Yeah, we have a map on our website that outlines where it's a state map. There are differences between the states, like Massachusetts, where I am, for example. If you're a corporate taxpayer, they comply completely with the OZ program. So you get these same benefits at the state level that you get at the federal level. And everything we've been talking about today is federal. But if you are an individual in the state of Massachusetts, you do not they do not comply with the Opportunity Zone tax program. I can go into the politics of it later, but it's just the way Massachusetts law is written. They are non-conforming to the OZ program for the individuals, but for corporations, they're 100% conforming. So you got to check each state. And on our site, I believe we have two maps. One is of the individuals and one is for corporations. But you want to make sure you're looking at the right map and see what's going on with your state.
All right, I'll take that as my cue to step back in. Thank you so much, Michael and Grace, for making today's presentation possible. I hope that all of our attendees received what they came here for. I know you guys were letting me know at the outset what you're hoping to learn. If you still have any unanswered questions, feel free to use that link to book a consultation. I'd also drop that link in the chat as well. Any other questions, feel free to utilize Michael's contact information, which is right up there on screen. We'll go ahead and get your CPE issued later today. You'll have access to the archive recording, your CPE certificate, your course evaluation survey, and your handouts within 24 hours. I'll go ahead and send that link to the course evaluation survey via email. It actually should have gone out if it's not in your email inbox already. Go ahead and take the time to fill that out and let us know how your experience was today. Please check our event schedule frequently. We're always adding new courses and resources for our community of members. And with that, thanks again for being here, and we look forward to seeing you all very soon on a future webinar. Have a great day, everyone.